Welcome to the Deep Dive. We're here to help you understand the key global headlines from the last 10 hours or so, today being July 28th, 2025. Our mission, as always, is cutting through all that noise. We want to pull out the important bits of knowledge and, crucially, see how seemingly separate events actually connect. Okay, let's unpack this.
Exactly. And what's fascinating here is seeing those connections. This isn't just news roundup. This deep dive, well, it's designed to help you grasp why these developments matter across trade, finance, energy,
Right.
even, sadly, natural disasters. We're looking at the broader implications.
Right. And speaking of those connections, let's start with some really big news on the trade front. It looks like the U.S. and the EU have reached an agreement.
They have. It's a 15% tariff framework on imports. And the key thing is, it seems to halt what could have become a pretty damaging tariff war.
And the markets reacted well, I take it.
Oh, immediately. Very positive. Global equities saw a surge. The euro strengthened too. And, well, maybe predictably, those safe havens, things like gold, they took a bit of a hit.
So this agreement, it sort of eased those immediate trade fears, just calmed things down a bit before those big central bank meetings.
Absolutely. It really acted as a kind of crucial pressure release valve. Gave the markets some breathing room, definitely contributed to the rallies we saw. It signals, well, for now anyway, a major friction point is off the table.
Okay, that immediate relief makes sense. But what's interesting, I saw some German commentary that was maybe less enthusiastic, a bit skeptical.
Yes, that's a fascinating counterpoint. There are analysts in Germany who are questioning the, let's say, longevity of this deal.
What are they worried about specifically?
Well, the warning is that this framework might be short-lived. And there's a concern it might be, skewed a bit in Washington's favor, even with the initial market relief.
So it raises that important question about who really benefits long term, doesn't it? And how stable these kinds of deals actually are.
Precisely. It suggests maybe this is more of a tactical pause, than a fundamental fix. Are we just kicking the can down the road on the deeper trade issues? That's the underlying question some are asking.
That's a really crucial nuance. And staying in Europe, there's another interesting trend. It seems like domestic-focused European stocks are doing better than the exporters.
That's right. They're actually outperforming, supported by record highs, and, volatility fading a bit after that EU-US deal news.
Why would that be? What's driving that specific split?
It looks like a bit of a pivot in investor strategy, maybe less chasing purely global growth and more valuing the stability of domestic markets. It could suggest investors are betting on sort of internal resilience within Europe to handle any future external shocks, given all the trade uncertainty that's still out there.
Interesting. Okay, so while Europe is dealing with that, let's shift focus. There's also movement on the U.S.-China trade front, right? High-level talks happening.
Yes, officials are meeting in Stockholm right now.
And the goal there?
Well, the main objective seems pretty strategic. First, extend the current tariff truce, which is obviously important. And second, maybe more significantly, try to pave the way for a potential summit between Trump and Xi. It's all part of that ongoing effort to manage tensions between the two biggest economies. A very delicate diplomatic dance.
Okay, so trade is definitely fluid, but often it's the central banks that really set the mood, wouldn't you say?
Absolutely.
And on that note, the Federal Reserve in the U.S., well, it sounds like they're holding steady. New inflation data seems to have put rate cuts on ice.
That's the phrase being used, yes.
Yeah.
The incoming inflation numbers mean there's very little expectation of any action before September, really, even with some political pressure maybe pushing for cuts sooner.
So if we connect this to the bigger picture, this just reinforces the Fed's focus on inflation above all else.
Exactly. It shows their primary mandate, inflation control, is still the top priority, regardless of political noise. And that signals to global markets, expect borrowing costs to be dictated by economic data for a while longer. That obviously has huge implications for investment, for growth, not just in the U.S., but everywhere. It could really shape things for the rest of the year.
And you can already see those ripples hitting Asia, right? China, India, markets there seem cautious.
Very much so. It really highlights that global interconnectedness we talked about.
How specifically does that caution show up? What are traders watching?
Well, traders in places like Mumbai and other big Asian centers, they're definitely getting more cautious.
Yeah.
They're watching these upcoming Fed decisions, yes, but also those key tariff deadlines we mentioned. And that caution, it directly translates into pressure on currencies like the rupee and on bond yields the cost of government borrowing. Because, if U.S. rates look like they might stay higher, dollar assets become more attractive, potentially pulling capital away from emerging markets. It's a direct link.
Okay, so central banks are holding, trade is tense. Let's look at energy. There seems to be a major shakeup in the diesel market. Something about EU sanctions.
Yes, new EU sanctions targeting Russia's oil industry are really having a big impact. One source described it as supercharging the global diesel market.
Supercharging. How so? What's the mechanism?
Well, these sanctions, they're fundamentally reshaping how diesel flows around the world. Established supply routes are being disrupted. And because supply is already pretty tight, this disruption is pushing prices up quite significantly. It's a clear example, really, of geopolitics hitting essential commodities and, well, ultimately costs for everyone. It's forcing a big rethink of supply chains.
Wow. And yet, demand for diesel is still strong, despite these higher prices and disruptions.
It seems so, yeah. Demand in major economies is holding up.
So, how are importers actually coping? It sounds like a mess.
It's definitely a challenge. The low inventory levels, the low stocks, mean refiners, can actually get better prices, what we call higher refining margins. Their profit per barrel is up because supply is tight, even if volumes aren't huge. But yes, for the importers, these new sanctions are forcing them to completely pivot, find new suppliers, reroute shipments, offer over much longer distances. It's a huge logistical puzzle.
Okay, before we wrap up, let's just take a moment. Beyond economics, there's a critical humanitarian story unfolding too. Catastrophic rainfall in northern China.
Yes, unfortunately. It's a very grim situation developing in Hebei province. We're talking devastating floods, landslides. The human cost is already tragic. At least 4 people confirmed dead, and over 4,400 have had to be relocated, and the risk is still very high there.
It's such a stark reminder, isn't it, that all these other global events, these human tragedies, are happening at the same time as the trade deals and market shifts.
Absolutely. It puts things in perspective.
So what does this all mean? We've covered a lot. Complex trade deals, central banks holding firm, energy market shocks, and tragic natural disasters.
Well, I think the aha moment, the real takeaway, is just how incredibly interconnected everything is. It's undeniable understanding these threads. How a tariff deal connects to investor strategy in Europe, how sanctions ripple through global fuel supplies, how we have to remember the human impact of weather events alongside market news. That's what helps you become truly well-informed. It really hammers home that critical thinking is just essential with so much information flying around.
Absolutely. And maybe something for you, the listener, to think about as you step away from this deep dive. Considering the sheer speed at which all these major global events are unfolding, from these detailed trade negotiations to sudden natural disasters, what does that tell us about the resilience or maybe the fragility of our interconnected world? And what could be the next unexpected ripple effect we should be watching out for?
Yeah, and this raises an important question, too, about how nations are going to keep balancing, economic stability with all these geopolitical pressures and now increasingly environmental realities. Looking at today's headlines, what stands out to you as the single biggest challenge woven through all of this? It's worth pondering.